Good morning and welcome to our property market update. Welcome to our Menzies clients who are attending, and also for those non-clients that don't know us. Menzies are a top 20 audit, tax and accounting practice that turns over about £65 million, and property and construction is the firm's largest sector specialism. This webinar is part of an ongoing series of webinars, seminars and articles that we publish on a regular basis to assist our clients navigate the property market. Over the years, when we've had these property updates, I think I've always reflected, they always seem incredibly timely. And I think that's because the property market, there's always something affecting it. So over the last sort of 15 years, we've had the banking crisis, followed by austerity. We've had the run-up to Brexit. We've had Brexit itself, the post-Brexit period. Then we've had the pandemic. And now we're coping with the post-pandemic fallout of high inflation, high interest rates, and the total change in working patterns that's affected the commercial property market, where obviously a lot of people are now doing 3 and 2 and working from home. So once again, it feels ever more important for our investor, developer, and other property clients to understand where both the residential and commercial property market are going. So I'll now hand over to Tom Sharman, who's our guest speaker today. He is an economist and head of research and strategy for real estate finance for NatWest Group, where he advises senior management on risk appetite and growth opportunities for their circa 24 billion commercial real estate loan book. Just before I do, we welcome questions. So if you do have any questions during the course of the presentation, please put them in the Q&A box. And my colleague Tom Woods will put those questions to Tom when he's finished his presentation. So over to you, Tom.
Thanks, Ralph. Good morning, everybody. I hope the shocking assault on your eyeballs from Menzies yellow and NatWest purple hasn't been too much for you this morning. But given how gloomy it is outside, perhaps it's for the best. But as Ralph says, whenever we get together for these things, there is something new and, in inverted commas, exciting to talk about. There's always some black swan event that's occurred to the point where you think perhaps black swan isn't a relevant term anymore, but nonetheless, there's always keeps my job interesting. And where to start? The only place a banker to start really is interest rates. So onto the first slide, please, Lucy. Thank you. So rates, as I say, I think clearly it's been a serious shock to the system. We've spent the last 8 years or so at the bank trying to work out when rates were going to rise and what how they were going to rise. And the one thing that I always suspected was that when rates started to rise, it would be much faster than we thought, because the only reason why rates would rise was that inflation got out of control. The only challenge with that, a great bit of foresight, was that I had no idea when they would start to rise, and that has been the problem with planning. So clearly, as I say, it's been a shock to the system. Rates have gone up incredibly fast, as everybody knows, and that has had a huge impact. In our book, clearly, ICRs have been squeezed, and it's been challenging for borrowers and investors across the market. But I think this is where, I guess the good news starts in a way, is that if we look at the forward yield curve in the market today, the market is expecting that rates have peaked at 5.25%, and that we'll start to see rates come off around the middle of next year to the point where they get down to about 4% by late 2025. So good news in there is that, we seem to have a bit more stability of kind of expectation. I guess the bad news, if you're looking for that, is that, I don't think anyone expects rates to get down anywhere near where they were before. So we have to consider ourselves to be in the new normal, or probably, as some of the older ones amongst us will recognise, much like the old normal, where rates are kind of typically between 4 and 5%. On to the next slide, please, Lucy. So what does this mean for house prices? And I have to apologise for the charts. I'm contractually obliged to put at least one chart in. So I thought I'd squeeze it in at the beginning so we get it out of the way. But I think it's important, and I am a numbers man, really. So I like to kind of form my opinions based on the maths. And a lot of agents will tell you, a lot of estate agents will tell you that mortgage market isn't that important because lots of people buy their houses with cash, and et cetera, et cetera, et cetera. But fundamentally, mortgage affordability is the primary driver of house price movement. So forgive me for this rather complex looking chart, but what we're looking at here is that a notional first-time buyer with a 10% deposit and £1,000 a month mortgage budget to spend on their mortgage, they could have afforded 2 years ago a £300,000 property. Now, throw in the increase in rates. So a 2-year fix at 90% LTV would have been 2% in 2021. Today, closer to 6%. The impact of that means that £300,000 budget, despite having still a £30,000 deposit, has now been squeezed to £195,000. Incredibly dramatic loss in spending power. Now, just in case the power cuts out and it ends right here, I want to tell you that I'm not predicting a 35% fall in house prices, and I'll explain why coming up. The first thing is that we've had very strong nominal earnings growth. So clearly the papers are full of stories, quite understandably, about real earnings, about how earnings are squeezed by inflation, etc. But in terms of nominal house prices, the fundamental element is nominal earnings growth. So your cohort of first-time buyers, who are typically professionals in the kind of early 30s range, have seen earnings growth of about 15% over that period. And that builds, therefore, their budget back up on the same assumptions of a 90% mortgage, on the same assumptions of 10% deposit, has built their kind of spending power, their budget back up to 220,000. But nonetheless, still 25% below where it was just 2 years ago. So how then can people afford prices anywhere near where they are today? The third element clearly is how much people spend of their day-to-day earnings or their disposable income on the housing, on the cost of housing. And the kind of the long-term figure ranges quite widely, but in 2021 the number was about 30%. So your average first-time buyer was spending 30% of their earnings on their mortgage repayments. Now, there is certainly scope for people to increase that, and we've seen in the past. I can certainly remember 2007, that the average was about 45% then, and I'm guessing perhaps maybe Ralph can remember the early 1990s when it's about 50%. Being bold there on that assumption, but nonetheless, there have been times when people have spent a lot more money on their mortgages than they do today. So there is scope to growth. But on to the next slide, please, Lucy. Thank you. So take us back to 1990, and for those of you who can remember, it was a great time. There wasn't a lot going on. In the average household, your monthly outgoings were linked to your telephone, your gas, and your electricity. Not a lot else. And for the younger ones amongst you, telephones used to be wired into the wall, and the only thing we really used them for was to ring each other and ask each other which of the 4 television channels we were going to watch. So it was a sad time. But moving forward to 2023, we have a much different picture. Now the average household will have subscriptions coming out of their ears. Some of these clearly are quite frivolous. I mean, anyone who has to kind of have a Pret subscription to get their caffeine fix, perhaps could drop that if they had to. But on a serious note, there are many more kind of monthly payments. So car finance is a hugely big one. There's a reason why back in the kind of 90s and the 80s and earlier, most people drove Ford Cortinas, and that's because everyone tended to buy their cars outright. So only the very wealthy could afford, I guess, high-end cars. Whereas today, if you drive around, you see Range Rovers coming out of your ears pretty much everywhere. In the old days, they would only be in the local gangster or maybe the occasional farmer who had a Range Rover. Now everybody does, and the reason for that is they've got huge kind of monthly payments going out. So the reason why I illustrate this point is there is less scope these days for people to spend a higher proportion of their monthly earnings on housing costs because they have many, many other requirements. And as we touched on, whilst you can cancel Netflix and you can cancel Spotify, you will also have large monthly payments that go out regularly. So on that point, I don't think there's a huge amount of scope. But on the next slide, please, Lucy. Another chart, I'm afraid, last one, I promise you. But this is just to illustrate the point where if we were to move from where we were 2 years ago, where the average person was spending 30% on their mortgage costs, and we kind of scroll forward to today, you can see in the data that the average first-time buyer in the current market is spending 40%. The caveat I would add to that is that this is in a very, very slow market, a very, very kind of weak transactional market. So whilst we've seen that buyers have been able to stretch from 30% to 40% of their earnings, clearly this has come at the cost of a lot less activity. So I think the expectation that buyers could or even should spend 45 or 50% of their earnings on housing costs is, I think, the wrong way of thinking about things. I think potentially we could stabilize at about 40%, which is roughly in line with the long-term average. So the reason for battering you with all those numbers really is to get back to the budget, this notional budget. So once we take into account the impact of higher interest rates, which takes you down to a very low number, we then build back in earnings growth, which improves the picture a little bit, and we then put in budget stretch. So we have people paying 40% of earnings instead of 30%, which was kind of an abnormally low number. That gets you back to 270k. So in broad terms, what I'm saying is that this underwrites our expectation at NatWest that house prices will come up about 10% from their peak. So we are, in terms of where kind of market indices suggest at the minute, we're about halfway through that movement. Clearly, as all of you know on the call, that the housing market is not an amorphous blob. Not every property moves in the same way as every other. But in terms of kind of the average picture, we think the prices will come off by about 10%. So moving on to the next slide, please, Lucy. So, you know, where do we see the housing market going from here? I think that for the next at least 3, probably 6 months, you're going to have a very slow transactional market. Even though we've seen mortgage rates start to come down, so you're starting to see the first 5-year fixes come in at sub 5%. So definitely the picture has improved. Absolutely no doubt about it, the picture on rates has improved. But nonetheless, there's still very, very shaky confidence in the market. Rates still are clearly much, much higher than they were a couple of years ago. You still had that to filter through into the market with people rolling off 5-year fixes onto new rates. So undoubtedly, this winter is going to be one of relative kind of discontent. But I always like, despite being an economist, I always like to try and look on the bright side. And I think there are kind of positives to take from this. You know, 6 months ago, markets thought rates might head up towards 6 or even further than 6% in terms of the base rate. So we could have had a much, much worse picture. And as I mentioned at the beginning, markets are now implying a peak where we are today and then a gradual runoff. And you see this from 5-year swaps, which are the kind of the fundamental, base point for fixed rate mortgages. And you've seen kind of swaps come off to kind of low 4s, which should imply that we should start to see more cheaper mortgage products coming out in the market over the coming months. But as I say, my view is I think that we will still see a very, very quiet market. But I do think that come spring, the combination of rates, which I think will have drifted down somewhat, and the fact that prices will have adjusted. And as I mentioned earlier, the various indices nationwide, Halifax, the ONS, show roughly 5% off prices from the peak. The one that I find quite interesting is the Rightmove index, which is built of asking prices. And this tends to be what I call kind of the index of delusion, because it tends to be what buyers want rather than what sellers will pay. The reverse, sorry, what sellers want rather than buyers will pay. But what we're starting to see now is that we're starting to see those prices adjust. So we're starting to see what I think is kind of creeping realism coming into vendors in the market. And this is absolutely a good thing, because clearly we talk about values going down, which sounds bad. But in fact, we're also talking about prices going down, which is fundamentally a good thing, as long as it remains in control. So I think what we'll see is, as we get into spring, we'll start to see confidence coming in, buyers looking at their budgets and thinking, okay, I'm more confident of where the mortgage market is now. There's cheaper products coming out. Vendors starting to become more realistic. And that lays, a solid foundation for the spring. So as I say, 10% correction, but I think then that means that come spring and summer next year, we start to see a more robust market. Of course, what that probably means is that if you are kind of opportunistic, that these kind of dark winter months, maybe, an opportunistic time to pick up assets. Next slide, please, Lucy. So taking a taking a switch now over to the commercial side of real estate. The other part of interest rates that perhaps is less thought about. So one side is clearly the cost of mortgages, the cost of loans. The other side is the opportunity cost. So the risk-free rate, what we consider as the risk-free rate, the 10-year gilt yield, when I last checked, was about 4.2%. So in effect, the government will pay you over 10 years every year, 4.2%, no risk, no effort, to do nothing at all. So we need to keep that in mind, all of us as property investors or being involved in the property market. You can get 4.2% for doing nothing and taking no risk. So it's fundamental that when you plan your investments, that you are realistic about growth, that that you keep in mind what required return you need. So broadly speaking, for a risk-free rate of 4.2%, broadly what we're saying is from real estate investment, you should be getting at least 6 to 7% per annum for a kind of core investment. And the good news is, I think, from my perspective, that if you are in the market today and you're looking to acquire commercial property, I do think that there are opportunities out there. So on the next slide, please, Lucy. So within the commercial real estate space, starting from the very kind of the most basic, not basic, but the most kind of low risk, the most predictable part of the market, the secure income part of the market. If we look at a couple of examples here today, you could acquire out in the market today a supermarket lease to Tesco, who are the strongest kind of covenant in the supermarket space, with a new 15-year lease linked to CPI, so effectively collared at 1%, capped at 4% is the typical structure. That means that each year you're getting kind of compounded 1 to 4% growth in line with inflation, which then feeds through every 5 years on your rent review. That asset could be bought with an initial yield of 5.25%. So that would be your day one return, 5.25%. You're then guaranteed those kind of inflation-linked uplifts through the period of your ownership. My view, therefore, would be that you can assume a minimum of 1% growth because that's contractual. We would expect CPI to be north of 2% for most of that period. Therefore, you're getting in a 7% plus return with very, very little risk. The risk for these kind of assets is interest rate risk. That is where you are at risk, and that's why values of such assets came off quite sharply last year. But where we are today, where the markets expect rates to be flat and then coming down, this seems like a kind of pretty good moment to look at these kind of assets. Moving on to the next slide, please, Lucy. More kind of, I guess, you're getting your hands more dirty, getting involved more in occupier risk, getting a little bit more involved in a kind of core plus return. What I always say for most investors is to look local. You know your local market. You know where assets are. Where kind of retail assets are busy. You know where footfall is high. You have a good kind of concept of where there is kind of tenant and customer demand. And again, in this space, I think there is value. So we're looking at things from a different perspective here. There's no guarantees in these markets. You don't typically have a long lease. On this picture here, you've got a Costa, which would be a good lease, but you don't typically have a long covenant, a long lease, I beg your pardon, on a strong covenant. You're typically taking more risk on the occupational side. But nonetheless, a lot of local retail rents have been rebased in recent years, so they've come off by 20, 25, 30% from their peak, 5 to 10 years ago. As I say, they tend to be kind of convenience retail. They tend to be more kind of along the essential side of things. And as I say, you can see quite clearly where footfall is high. So to my mind, as a real estate investor, typically these assets will yield you maybe 7 to 8% on day one. They're not as risk-free, they're not as effort-free as the previous slide, the kind of the predictable income, the secure income side. But nonetheless, I think where you can be fairly confident that the rent is rebased, the rent is stabilized, you can see that there's good footfall, you're getting a decent yield on year one. It's not very hard at all. There's no heroic assumptions required to get you to expect a return of 7 to 8%. And again, against the risk-free rate of 4.2, that seems like a reasonable place to be. On the right-hand side there, an office building, and I think, you know, as Ralph mentioned earlier, there's huge changes afoot in the office market, but I see it as two separate things. There's the corporate office market, which I'll come on to in a minute, and then there is the kind of local and mainstream office market. And I think touching on the former, again, in your local area, you will know buildings that have been constantly in occupation. You will know areas which are stronger than others. And the things really to look out for are offices that are sized for mainstream local demand. So you don't want the big carbuncle that sticks out on the edge of town that is way bigger than most other offices, that's typically been occupied by a corporate back office space, for example. There's huge risk in those buildings, huge obsolescence risk. What you're looking for is a building that will cater for mainstream local demand. So small floor plates, you know, floor plates of maybe 1,000 square feet, where you can subdivide it. And then, you know, you're catering for local demand. Your rent has been rebased because it's typically short leases. You're really running an asset for cash. One thing I would say is that one of the changes that has taken over the office market, particularly at the smaller end, is that customers, tenants really want space to be ready. They're really looking for space that's been fitted out. Plug and play is a phrase I hear very, very often. You know, where customers can move in, everything is fit out, typically Cat A plus or Cat B fit out. So it's fully furnished, everything's ready, customers can move in and they can start on day one. Typically they're looking at shorter leases, and you might say 2 to 3 year kind of leases in this kind of space. But I do think that that's what landlords should seriously consider doing. And it really helps to mitigate letting up time. It helps to mitigate voids. Yes, there's a higher upfront investment, but certainly you are much better placed in the market today to find tenants if you have a space that's fitted out to a decent standard. Moving on to the next slide, please, Lucy. So I mentioned kind of offices, and as I say, Ralph mentioned earlier, the kind of changes in working, in the ways of working, and I am sitting at home today. I would normally be in the office on Thursday, but typically I'm at home probably 2 days a week, and I would say that, you know, that is probably fairly typical of the corporate landscape, that people are in the office probably 3 days a week, and going back to how it used to be, 4.1 days a week was the average years ago, pre-COVID. And now I think that we'll move to about 3 days a week. Now, this does mean that there is a lower requirement in aggregate for space. But as those mathematicians amongst you will have figured out, 3 days a week still means that 1 day of the week at least, lots of people are going to be in the office. And typically Tuesday, Wednesday, Thursday are busy days. And in my experience of traveling around clients and other offices, is that typically those days are pretty close to being as busy as where they were before. So I think what we have is a decline in aggregate space, and typically the real hit comes in back office operations, where there is less motivation or less requirement for employees to be in the office. There is perhaps less benefit, less desire from those people to be in the office. And I think you will get some of this corporate back office space really suffering from obsolescence. But on the flip side, I think corporates will pay very handsomely to get space that will attract employees, that will get employees into the office, that will impress, will help with recruitment, that will impress clients, etc., etc. But the wish list for these things is incredibly high. So, you know, typically these offices want to be close to major transport hubs. Those of us who live much further out from the city, if we're going to come into the office, we want it to be convenient once we get there. Perhaps even more importantly than that, there needs to be amenity around. When we go into the office now, we want to be able to see clients close by. We want to be able to meet friends after work, etc. So location, absolutely fundamental, as it always has been, but even more so now. And the fit out needs to be very, very high quality. And there's multiple aspects to this. The sustainability angle clearly is key, and no large corporate now will take a new building that isn't BREEAM excellent or neighbours rated or LEED rated or wellness rated or any of these things. So if you're going to deliver corporate space, it needs to tick all these boxes, and the build costs are incredibly high. So I would put it as a high risk, high reward strategy, rather than something kind of more core. Finally, then moving on to my last slide, Lucy. Finally, moving on to kind of the structural growth piece, and what I think of as being the most interesting as kind of a real estate guy, is the areas where you think there is going to be growth. So you are building, you're buying into a structurally growing market. And the first one of these on the left hand side is logistics, but really what I'm really talking about here is urban logistics. And it's not necessarily pure logistics as in shuttling parcels around like this guy here, but it covers all kinds of things like dark kitchens, for example. All the things where we will contentedly sit at home and order something in now, be it a parcel or be it a pizza or be it a curry or be it anything else. They need space within urban areas, and this space is at a premium. So we look, when we talk about parcel delivery, about 30% of retail these days is online. There's talk about it falling back after COVID, which I guess is inevitable when shops actually reopen and people feel brave enough to go outside again. But it hasn't fallen back materially, and the trend is still going north. And even more than deliveries, it's returns. And the statistics will show you that in Germany, 80% of clothes orders ordered in Germany are returned. And I dare say the number is fairly similar. If my householders are meant to go by, multiple clothes arrive through the door and many of them go back. And I don't think that's an unusual thing. And this all needs huge amounts of logistics. It's like in Disneyland, you don't necessarily see it up front, but it's all happening behind the scenes. And that requires space, and there's very little of it. So, this market, if you are able to get logistics space, urban logistics space in metropolitan areas, urban industrial space, it has huge value. But despite all that, we're still losing this space. It still gets taken out for resi and other uses. So again, supply and demand dynamics hugely strong. You may have to pay quite strong to get this. So yields typically only 5%. And if you remember, the government will pay you 4.2 to do nothing. But I'm confident that the rental growth that we've seen will continue, perhaps not at the rate we've seen it, but I still think getting 2 to 3% rental growth per annum is a fairly confident assumption. Finally, going full circle to where I started on residential, I think we have a really unusual and really kind of strange market here where the occupier fundamentals for residential investment are hugely strong. The demand for residential investment continues to grow. It's harder and harder to get on the ladder as a buyer. Mortgage costs clearly have made that even more extreme. Yet in this country, buy-to-let landlords have been relentlessly squeezed by government regulation, by taxation, and you've started to see a net flow out of the market. So where for many years we had strong growth in that market, now we've got a net flow out. So while I don't ignore any of the challenges that landlords have, and Ralph and Tom know more about this than I do, but I don't deny any of those challenges. But if you are able to access that market, you have very, very strong supply-demand dynamics. And not only that, but your raw material prices are coming down. As I say, prices for rental resi property are down about 5% from peak. We expect another 5% off. And in certain markets, clearly that number will be even wider. So I think this is actually a really, really strong moment for residential investment kind of acquisitions, acknowledging the kind of challenging backdrop. And I think probably that's, I guess, a reasonably sensible place to stop my monologue and hand back to Ralph.
Okay, thanks, Tom. That was actually probably significantly more positive than I was actually anticipating you were going to be, because the market always does seem to be quite dynamic and problematic. Just picking up on one thing you said, I think my first mortgage was 10.25%, which of course was the norm, and it was a NatWest mortgage, but that was back in the 1990s. So it shows how much of your income back in the 1990s you were applying to paying your mortgage interest. I think there tended to be more repayment mortgages also rather than interest-only mortgages. So probably the start. So people were committing a lot more of their available funds, and I guess that does allow a bit of flexibility in the market today for people to get used to the higher rates and go back to paying a bit more of their disposable income to finance a property purchase. just picking up on the residential market, how does it tally? Because it seems to me that if you take young professionals as a group that are quite high earners, they passed their exams, they're now, whether they're qualified lawyers, accountants, they're earning probably twice the average wage for the country. But they're still on a multiple of mortgage, mortgage multiplier of their salaries. They still can't get to, say, if they're earning 50,000, if they do 4 times, you get 200. Well, you still now need another 100,000 to get to a 1-bed flat, probably more than that, actually, if you look at the south of England. So how does what you were saying tally about the market increasing? Because if the market prices the residential prices continue to increase, these prices are just going to become more affordable for those people trying to enter the market.
Yeah, look, absolutely, Ralph, and I certainly don't downplay the challenges people are getting on the ladder, and I think that is one of the key fundamental drivers for the residential investment market being kind of so strong in the coming years. But I guess to address the point on multiples, it's pretty rare these days that somebody in the southeast will buy a house off their own single earnings. Typically, you've got two earnings kind of going towards it in order to make it affordable. And unfortunately, I guess it's a feature of the market that a lot of people get help with the deposit from perhaps parents or grandparents. So you're right that when you look at the bare mathematics of what average earnings are and what house prices are, the multiples are eye-watering, particularly in London. I think the average multiple in London is almost 10 times. But when you, as I say, when you look at, typically it'll be combined income, and typically, or quite often, people will be getting help with deposit. That mitigates that to some extent. But absolutely, I'm not downplaying that. I think what helps is that with prices coming off, and as I say, we would expect prices to continue coming off over the next few months. But with prices coming off and with earnings growing, that income multiple has actually shrunk back. So we are seeing some reduction of that income multiple. We would see, incomes, as I say, have gone up by about 15% over 2 years. Prices we expect to go up by about 10%. Therefore, you get a fairly material reduction in that house price multiple. But by no means will the UK be a cheap place to buy a house, or even a relatively affordable place to buy a house. Challenges will remain, and it will become increasingly an affluent person's privilege, I guess is perhaps the way to phrase it, to be able to buy, a house in the southeast, but from their own earnings. And increasingly, more and more people within London and the southeast will end up staying in the rental market for longer.
And looking at I noticed Land Securities published some results this week, which were showing a further decline in the capital values of their portfolio. I think what you're suggesting now is there may be a sort of some further decline before then an uptick in the marketplace on the commercial side.
Yeah, I think that's right. So I would categorize commercial broadly into four pieces. So within the office space, which makes up a very large chunk of what Land Securities have, for example, office asset values are still under pressure. But there's two things I would comment on the Land Securities numbers, and other REITs were similar, is that we're looking at the period from March to September. Values definitely adjusted in that period. So the decline in asset value within those companies was a function of outward yield shift, i.e. yields are rising, multiples that people are prepared to pay are falling, and that is driving values downwards. But actually, if we look at the fundamental income side of the equation, both of those REITs and many others reported kind of rising income. So they were letting space at rents in excess of where their estimated rental value was, in excess of where their book value was. So again, you've got a situation where capital values are falling, rental income is actually rising, which is a positive for any investor looking to move in today. And just to be clear, I'm not making recommendations of share acquisitions, but if you're looking at an asset, or if you're looking at a company and the income yield is increasing, and you have some reasonable degree of confidence in that going forward, then that's a fairly good place to start. And as I say, I think where the real challenges are in the office space are more secondary, older assets that are kind of harder to bring up to modern standard, perhaps in more fringe locations. And there, I think you'll see very, very substantial value loss. But that kind of gets lost a little bit in the averages. So in the averages, you'll get some prime assets where we think rents will continue to rise and asset values will hold up. At the other end of the spectrum, you'll get assets where the value could fall to almost anything if they need to find an alternative use.
Okay, thanks a lot. So just handing over to Tom Woods. Tom, have we got any questions from the audience?
We do, yeah. So yeah, thank you, Ralph. Thank you, Tom, for your presentation as well. So we've got one from Richard, and it's one that we did have in advance of today as well, just around any noise around next week's mini budget or autumn statement. What would you like to see included within that, maybe to give the residential property market a little bit of a boost? It's probably a question for both of you, actually.
Yeah, no, I'll fend off first in that, Ralph will possibly have a better idea of what will come out of it. I'm going to tell you what I would like to come out of it. Despite NatWest being partially owned by the government, I have no inside line into what they're going to do. But what I would say is that, the big problem that I see in the housing market today, and we all know that there are many challenges, but the biggest problem I see is the release of family housing, family homes back into the market. So you get a lot of older people who are remaining in kind of large family homes because they're not incentivized to sell. There are various tax reasons that you guys will be cognizant of that make it more appealing perhaps for somebody to hold on to that house and pass it down to their inheritance through their inheritance rather than sell and move into something different. So not only do they have the emotional tie to their house, the reluctance for all the hassle and stress of moving, but there's also kind of tax-based incentivization for them not to move. And one of those elements is stamp duty. If they move out of a house that is now worth a lot more than it was when they moved in, even if they downsize, they've still got a big ticket to pay on stamp duty. So I would like to see something around stamp duty that helps that downsizing, helps get more of this product back in the market. Because which is a great thing. We're living longer than ever, but it does mean that more and more of that kind of family housing stock is being retained, perhaps where it's not needed, and less is getting down to for young families who do need it. So that would be my desire. I have absolutely no idea whether it's in the pipeline, but I would like to see it.
Yeah. I mean, I totally agree on stamp duty. I mean, it's a tax which, I mean, it's difficult for the government to change it in some ways because every time they change it, the property prices just change. So when they reduce the cost of stamp duty, the property goes up. But I do think it's a big inhibitor to movement in the property market, and it is inhibiting sales, and it makes the cost of entry for the first-time buyer is very difficult. So I think we too would like to see some sort of stamp duty reform to assist the market. Certainly, a reduction of the 25% corporate tax rate would be a big help because that's going to restrict investment going forward. And I think the residential market has been a particular soft target for the government to raise taxes over the last decade. Certainly through the austerity years, we've had multiple new taxes come in. So, and particularly for landlords, with the extra stamp duty charges for second homes, which would be buy-to-let properties potentially, and the restriction on interest tax relief. So we actually now have a situation where some landlords would actually be paying tax whilst making a rental loss. So there's certainly some reform there of the way landlords are taxed would also be welcome, I think.
Okay, thank you. And then we've had one person as well, probably just picking up on your point, Tom, on the residential market and the kind of opportunities there. And they're saying, just to reiterate, that you think it could be fruitful in time potentially there. And linked to that, are there any particular areas in the UK as well that you think may experience further growth than others or more growth than others? And is there any kind of link there with HS2 potentially as well, and the cancellation between Birmingham and Manchester and anything around those things?
Oh, thanks, Tom. So I guess, I look at things in kind of broad trend terms. So the way I see things is that what we've had leading up to COVID, leading up to the kind of change perhaps in working practices and perhaps changing some commuting patterns, is that we had incredibly strong growth in the kind of inner commuting circle around London, for example. So those kind of prime commuting towns around London became incredibly expensive, close to inner London prices. And I think you'd probably expect to see some kind of softening of those prices. And in contrast, thinking about it from an owner-occupier perspective, that the further the outer commuter ring, as it were, so thinking as far afield as perhaps parts of the Cotswolds, perhaps up into Cambridge, perhaps down kind of Bath way, you see perhaps an area of the country which wasn't really in commuter belt territory before, but through the prism of people going into the office 2 or 3 days a week, suddenly becomes a more realistic proposition. So I think we would see strong growth there from an owner-occupier perspective. From a rental perspective, I think there will be interesting opportunities within the kind of urban, kind of major regional cities markets. I think for a long time they were quite neglected. Post GFC, you had a lot of stories of kind of value loss coming out of these markets. Leeds was a notable example. And you had a bit of a retrenchment. Post COVID as well, people talked about moving out of the cities and moving into the countryside. But actually in the regional cities, there's much less of a trend in that way. There's much less of a working from home trend. And actually there's an increase in kind of urbanization trend. We've seen quite a lot of development of build to rent, so big institutionally owned kind of schemes. And we think that will continue to grow, but really it's a tiny part of the market. So I think there'll be opportunities in those regional cities for investors looking to pick up stock, which yields a little bit higher than where we are down in the southeast. And I think has kind of positive demand drivers behind it as well.
Okay, thank you. And while we're just talking about the resi market as well, so we've got a question from Patricia Lewin, who said about interest rates may be improving, but there seem to be increases in some arrangement fees, which can cancel out some of those savings. Is there any advice or anything around there or anything you'd like to see?
Yeah, it's a really good point, And we see this quite a lot because when as a lender, you do your kind of affordability calculations, you're requiring a certain amount of interest cover over and above the rental income. So you're looking for your rental income, I should say, to cover your interest by a significant margin. Now, in order for that to happen, clearly higher interest rates are a serious challenge. So what you're starting to see from quite a lot of lenders is they are keeping the margin down, or the interest rate overall down, but they're increasing the arrangement fees in order to get the return they need. So it's really a kind of structural change. In order to give customers the leverage levels they want, they have to reduce the interest rate, but in order to then get the return that they need, they have to increase the arrangement fee. So it's one of those things that is really a function of higher rates. In terms of where the path of rates go, I would expect to see mortgage rates come down over the next few months, unless we have a dramatic change in circumstances. I would expect to see mortgage rates start to come down, but it's still a challenge. That interest cover piece, that affordability piece, is still a challenge when rates are north of 5%.
Yeah, thank you. And then just a couple of things on the commercial side a little bit more. So you mentioned plug and play offices and high quality space. That was something that perhaps WeWork were offering, but obviously it hasn't worked for them. Any thoughts around that and why they've seen the demise?
Yeah, it's a really good question. I mean, and WeWork is a classic example of a fantastic product, really. I mean, let's face it, for all of us, going into offices on a daily basis, their offices were well located, they're brand new, they're nicely fitted out, they had concierge staff, they had free beer and coffee and all kinds of things. So, as a customer experience, excellent. As a business model, more challenged. They were prepared to take 20, 25, 30-year leases, but clearly they were only taking far shorter agreements from their customers. So it didn't take a kind of genius to figure out that if the market took a turn, if we had an event, which we did with COVID, then there would be a problem there. There'd be a cash flow problem. So I say it's two things. The WeWork product, great. The WeWork model, not so great. I think that fitted out offices, serviced offices, managed offices is going to increase steadily over time, and I think will become a much, much bigger part of the market. But it needs to be done in the same way that hotels used to be typically kind of owned, or they might have been leased. More and more hotels these days are management agreements, so that the owner and the operator are aligned. And I think service offices will go down that route. So there's more transparency. The owner takes more variability of return, but it's then more aligned with the operational return. And I think it's a false comfort for a landlord to have a long lease upwards only, if really they are exposed to the operational risk anyway. You might as well be explicitly exposed to the operational risk and then take some of the upside as well.
Thank you. And then just another one on the commercial office space. And you touched on the kind of the changes with people going into the office maybe 3 days a week rather than 4. Is there anything that you see on the horizon as well with improving technology, which may change that if we start working in the metaverse, or we have holograms where we can actually interact with people a lot better than we do over Teams or Zoom? Is there anything there that you see could impact the market in the future?
Look, I think there will be, and I think, you know, the older I get, the less kind of au fait I am with new technology. But the reality is, we know it gets better. Zoom is better than what we had 10 years ago by a country mile, and what we have in 10 years' time will be better than what we have today. So, you know, these online meetings and gatherings will be a lot better. But nonetheless, I think most people on the call would agree that we still enjoy, you know, face-to-face contact, and there's still great value, particularly for training, particularly for onboarding of new employees, particularly for kind of first customer engagement. There's huge value in being face-to-face. So I think, you know, the overall physical occupancy of offices will go down. Mondays and Fridays will probably remain pretty quiet, but I nonetheless think that, you know, those peak occupancy days will be close to where they are today, regardless of the fact that technology will improve. So, you know, our meetings, our calls that we have on Mondays and Fridays will be better than they are today, but we will still have that kind of human desire to meet in person.
Okay, thank you. And I know we've run over a little bit of time quickly, and we've got another question here on the residential market, which does verge into the political side as well. So I'll word it slightly differently. But in terms of immigration, is there anything that we would actually need in net inwards or anything like that to keep a long-term property price increases?
Yeah, it's an interesting way of looking at it. So we have had a steady population growth over the last 20 years or so, and that has underwritten some of this kind of perpetual kind of growth in prices. But so we would get less of that. But I think that's probably counteracted by the fact that people are living in smaller groups. So I don't think that you have a huge change in the aggregate amount of demand. So it may mean that house prices grow slightly slower than they have done when we had higher immigration, but I don't expect it to make a dramatic difference. In many ways, over the long term, house prices will move with earnings, with nominal earnings, and nominal earnings clearly kind of rise with inflation over time. So hence why house prices will grow over time. They're a real asset. They're moving effectively with inflation, with the broader market. But in summary, no, I wouldn't expect the change to inflation, so change to immigration, to make a big difference to the housing market.
Okay, thank you very much. Yeah, we've run over and run through most of the questions that we've had today. So thank you very much for everyone posting those today and in advance. And I'll hand back to Ralph.
Great. Well, thanks a lot. It just gives me the job of wrapping up and making some thank yous. So Tom, thanks so much for your insight into the property market. As I said before, it was more positive than I anticipated. So I'm hoping that we've left our clients with a little bit of a spring in their step when they finish, when they set off this seminar. To our clients, I hope everyone enjoyed the presentation and found it useful. Thanks to Tom Wood and our marketing team for coordinating the effort, because a lot of work goes into putting one of these presentations together. The slides will be available on our website after the presentation. And next week, we've got the Chancellor's Autumn Statement. So we will be emailing a link to our analysis of that Autumn Statement next week to you. Finally, if you do have any questions, please do email or speak to your Menzies contact partner, or you've got the details on the slides with email addresses of our core property team, top property expert team. So please feel free to make contact with one of those individuals as well. So thank you very much for attending, and look forward to probably you attending the next webinar. So thank you very much.